It's not just unicorns that are built by chasing evaluation or chasing funding, and it's not just unicorns that are built by earning trust. We're going to look at SMEs now in our Finance Reinvented New Credit Pathways for SMEs session. I guess the issue here is that as scale accelerates within your organizations, access to credit becomes critical, especially for these small and medium-sized enterprises. Traditional lending no longer meets the full needs of growing businesses. And across the region, alternative credit models are emerging to unlock liquidity, manage risk, and support expansion. To explore how new financing pathways are reshaping SME growth, can I please welcome our panel, led by Osama Alraee, co-founder and CEO of Lendo, Kingdom of Saudi Arabia, Dr. Bilal, Baloch, partner at Shorooq, and our moderator for this session, Yasmin, Almostehy, founder and managing director, Beacon Hills Advisory. Please welcome them onto the stage. Thank you.
Thank you, Stephen, for the introduction. Thank you to the audience for being here. My name is Yasmin. I'm the moderator for today's session. Today, we're going to be discussing 3 topics: how SMEs can access growth capital without losing control, what makes SMEs institutional ready, and what really matters if the goal is scale, IPO, or exit. I'd just like to take a moment if the speakers could just introduce yourself, introduce a little bit about your organization, and what stage you engage with SMEs in their growth path.
Sure. Osama Alraee, co-founder and CEO of Lendo. Lendo is Saudi's first debt crowdfunding platform. We do financing to small and medium businesses in Saudi Arabia, licensed in 2022 as the first crowdfunding Sharia-compliant SME financing platform. So far, we have financed now more than 5 billion riyal of SME financing, primarily focusing on short-term invoice financing or asset-backed financing to ease the SME's cash flow constraints. We do that through a marketplace model where the funders are crowdfunding or institution capital, family offices, private credit funds, and global banks. And the idea is to, the target segment we focus is primarily B2B businesses with revenues from 5-10 million dirham to all the way 400-500 million riyal dirham. So we're more small and mid-market financier.
Thank you. Bilal.
Well, good morning, everyone, and what a wonderful panel to be on, not least because Lendo is one of our portfolio companies, so it's always fun to be alongside one of your founders. I'm Bilal Baloch. I'm a partner at Shorooq. Shorooq is a tech-focused multi-strategy firm, born and bred out of the region. We're across the UAE, Saudi Arabia, Egypt, Qatar, as well as South Korea. We've made our reputation mainly investing across early-stage tech. We most recently launched the region's first late-stage pre-IPO fund. So now we cover the entire capital stack, and historically have invested mainly across fintech, but also deep tech, agriculture, advertising, and other areas of tech disruption across industries. We oversee about $1 billion in AUM, and are very proudly investing across the region, and most recently started the region's first global AI fund to invest in early-stage AI companies around the world, which is particularly noteworthy because it puts us neck and neck with other investors around the world that are competing for the best AI deals, which, at least for me on a personal note, is a great marker of where the region is heading when it comes to leading the investment space on cutting-edge technology. And it's a pleasure to be here.
Thank you both. So we have 2 complementary perspectives. Let's start with access to capital. Osama, I'm going to start with you. Many founders think that their only options in getting financing is bank loans or giving up equity. In simple terms, how does alternative financing help the SMEs access liquidity without slowing their growth and without them losing control?
So I think SMEs go through different stages, starting with their ideation, launching the business. And usually here at this stage, the best is to get equity. So you invest in your own capital, you get friends and family to start a business, or a restaurant, a coffee shop, any sort of a traditional business or that you want to start. And then as you start seeing 5 million real revenue, sometimes even earlier than that, here where the alternative financing options comes in. And usually the alternative financing options, they create products towards SME and micro where they can reduce their own risks. So in such stage, usually financing like Lendo focus on cash-based or cash flow-based financing. So in our case, we do receivable financing. The SME nowadays provided a service waiting for 60 to 90 days to collect the money, and he has salaries, suppliers that he has to pay to. So here we come in, and we are guaranteed by the invoice that he will get paid. In B2C businesses or e-commerce businesses, you can take a collateral on the payments that's going to come through the POS machine or the e-commerce. So you can take advance on their revenues. So usually at early stage, you have their top line revenue where you have control over and you can finance without actually giving any equity away. Now, as you grow the business, you start getting profitable, you have positive net free cash flows, and here where you can get also other sort of alternative financing with term loans, short-term, mid-term or long-term. And as you grow, then you need CapEx financing or growth financing to open more branches or new factory lines. And here there are some alternative financing options as well, but usually this is where the banks come in. So there's a big gap when it comes to 3 million to all the way 100 million real or dirham. The banks usually want to come later, and equity usually comes in earlier, and that's where I think there's a huge opportunity. In Saudi Arabia, we see SME financing gap for this mid-market is more than 400 billion real. And in the last 5 years, the SME financing overall grew from 100 billion to now 450 billion. So this is just 7 years since the launch of Vision 2030. And still, after reaching 450 billion, there's still another 400 billion real gap. So there's a lot of opportunity for private credit, family offices to come and jump into alternative financing options. And same thing for SMEs. Now there are much more opportunity than just getting a family-friend equity or going to the banks.
And are there any indicators when an SME approaches you? What are your indicators that tells you that they're ready for flexible credit?
So look, in alternative financing lending, we look at overall of the SME's behavior, and we look at their personal behaviors as well, how they treat their own credit. So they're a lot of behavior focused. As in venture capital, you look at the founders, then the actual idea. We look at the behaviors of the entrepreneurs, but then we also look at how their cash flows are, how the receivables, the quality of that. I think one of the key areas that many SMEs have gaps is managing their books, accounting, and finance departments. We found amazing business owners who know their business, who knows how to sell, build the right product, but they ignore to have good cash flows or good accountant or finance department. And we see it repetitively. Even companies with 50, 100 million real revenues, if you ask them 3 questions about their finance, they don't know. And that's where I think a big financial literacy gap in SME. And we try to do market education, but with this education, we also look how we can have a disciplined lending, so we are not taking unnecessary risks, and uplift the ecosystem while providing more and more capital to them.
Excellent, thank you. So we know capital isn't the only thing that helps with scalability. Bilal, I'm going to move to you. And off of what Osama just said, what habits and disciplines do SMEs need to build early if they want to become credible and exit ready?
Yeah, look, that's a great question. And one of the key differences when we talk about SMEs is when we refer to SMEs, we're talking about technology startups. So, right, so with that in mind, I think the key here is institutionalization, right? How do you institutionalize from day one? And it's not just a matter of action, it's also a matter of mentality. So a startup from day one should be thinking about IPO readiness or an exit when it comes to its governance, right? What does its cap table look like? What is the dynamic between a founder and the board? How are they doing their reporting? How are they going about their financial projections, their audits? These are all things that don't happen just in the last mile. And unfortunately, the bar for doing this in a growth market that historically hasn't seen that many exits is even higher. So we really encourage and we want more startups and founders to be thinking in terms of IPO readiness or exits, just as a mental framework right from the outset. And that will make sure that when it comes to other tangential matters such as hiring, pay scales and offers, the kind of investors you let in, all of that will follow, right? I think second is about moving beyond capital and looking at value. It's very difficult for founders when they're on the early stages of their journey to think about being selective when it comes to investors. It's very hard because you're trying to bring about your moonshot idea, you're trying to hire people, you're oftentimes doing it based on little to no salary. Perhaps you've left your corporate job and people are depending on you. But the long-term gains of having investors on your cap table that can actually add value, connect you to customers, helping you even identify who your customers are, helping you to hire the right talent, bringing in other investors along with them. These are the things that matter most throughout your journey, which is often filled with more crises and down points than it is with sort of the big wins. And that's when the sort of rubber hits the road. So thinking about value from your investors from day one is absolutely critical. And then look, the third I would say, and I've alluded to it in the first 2 points, is about talent. I think too often we see founders taking the easy route and hiring very sparkly people with great CVs and great titles and paying them a lot of money. It boxes you into pretty significant burn rates. A lot of times those people's skill sets don't translate over to a startup environment where perhaps they don't have the same marketing budgets or the same velocity of learning to jump into different crisis areas, so on and so forth. So being very intentional about who you're hiring and not letting go of the reins as a CEO on critical functions, which can, for me, get boiled down to business development, right? We see too many startup CEOs too early on hire in a head of sales or a head of business development to go and sell your product. Fatal mistake, right? This has to be a CEO-led environment, not so that the organization is overly dependent on you, but so that you can balance between institutionalizing, but also leading the sales narrative when it comes to your clients. So those are the sort of three I'd map out.
We've actually answered my next question on the value that investors can bring into SMEs. I would imagine that it would be very difficult for a founder to assess this value of investor early on when, like you said, their primary is capital. How would a founder go about assessing whether an investor will bring in the right amount of value add to their organization?
It's an excellent question. Excellent question, and it is very difficult. I just met with a Japanese investor that's in town, and I asked them the same question. And they do something very interesting, which is they actually start making connections to founders for their ideal customers without investing in them, which is a pretty bold move, right, in terms of time, relationships, and the mileage that takes. I think there's a halfway house solution. I think you do have to ask as a founder, who do you know, what can you do for me, right? What relationships can you open up for me? Can I actually have an initial scoping conversation with those individuals or entities now? Who do you have in-house that can help me with my business development efforts, with my value creation efforts? I mean, not to make this all about us at Shorooq, but we are the only firm in the entire region with a partner-level value creation practice. We did that not out of, the goodness of our heart, but because we believe that the logic of the power law, which dictates our returns as a VC in a growth market, is helped far more, not so much by trying to find that odd unicorn, but actually helping a larger portion of our companies get to profitability, get to a place where they can be sustainable. And that only comes by helping them with customers, helping them with investors, helping them with talent, etc. So the founder has to take it on to ask that question, to see what's in-house, and help me understand that capability and connect me to your network, even while you're assessing our investment. It works both ways.
It looks like we're running out of time a lot quicker than I thought we would. One quick question for the both of you. Looking back at companies that you've seen succeed versus the companies that you've seen stall, what's the most common blind spot that founders overlook in their journey? I'll start with Bilal. Go ahead.
I actually think there's a lot of reasons that can happen, which is what makes making a startup successful so intimately difficult. So I actually think there's many reasons. If I had to pick one, I think CEOs that do not have a hawkish, strict handle on their burn rate invariably fall into this trap, because that is an indicator of poor financial literacy, as Osama was mentioning early on, which applies to all founders and SMEs. No one is immune. But it's also an indication of your wisdom around hiring, building operations, your go-to-market. So much is captured in that one metric, and there is a clear correlation between those that let that get away from them and aren't as hawkish on it, and those that taper off.
Osama?
So, of course, I echo 100% on that, but I would add an additional point, not on success versus failure, but more on how to increase success, is to be extremely focused on what's important to your business and kill all the noise. I think, especially in early on, even at I think all stages of the founder, all stages of the company, there's too much noise around you. And you think achieving this side KPIs, growing your business, but it doesn't. So I think a lot of founders need to really focus what are the levers in their business that actually help them grow, and focus precisely on that, and try to reduce the noise that they have on day-to-day basis, give it to the team. And for the founder and CEOs, they need to really focus on what's most important to their business.
Thank you. I wish we had more time. Unfortunately, we have to wrap it up. Please join me in thanking the panelists, and thank you for your time. I hope you enjoy the rest of the conference. Thank you,
Thank you
Bilal.
so much.
Thank you, Osama.